What is tactical passive allocation? Have you ever wondered how investors can balance the need for steady growth with the ability to react to changing market conditions? Let's talk about tactical passive allocation, a strategy that does just that. Tactical passive allocation combines the best of two worlds: passive investing and tactical adjustments. This approach allows investors to make short-term changes to their asset mix while primarily using passive investment vehicles like index funds or exchange-traded funds. To break it down, let's first look at passive asset allocation. This is a long-term strategy where a portfolio is built with fixed proportions of different asset classes, such as stocks, bonds, and cash. The goal here is to maintain these proportions over time, rebalancing only occasionally. The investments in each asset class typically track market indices, meaning they do not attempt to outperform the market through active management. On the other hand, we have tactical asset allocation. This is a more active approach where investors frequently adjust their asset class proportions based on short-term market trends or economic forecasts. The aim is to take advantage of market inefficiencies or anticipated movements to enhance returns or minimize risk. Now, tactical passive allocation merges these two strategies. It keeps a core passive portfolio but allows for tactical shifts in the asset allocation percentages based on current market conditions. For instance, if a portfolio usually holds 60% in equities and 40% in bonds, tactical passive allocation might temporarily increase the equity portion to 70% if the market looks favorable. Conversely, it could decrease the equity portion if risks seem to rise. For banks and credit unions, tactical passive allocation offers a balanced approach. It retains the cost efficiency and diversification benefits of passive investing, which aligns with the conservative responsibilities these institutions have toward their clients. At the same time, it allows for flexibility to manage risk and seek better returns by adjusting asset allocations in response to changing economic conditions. This strategy requires disciplined monitoring and clear guidelines to avoid excessive trading costs or emotional decision-making. Banks and credit unions can support this through their advisory services and portfolio management frameworks. In practice, tactical passive allocation is often used in managed investment products, retirement plans, or wealth management services. This approach provides clients with a strategy that balances steady, long-term growth with the ability to adapt to evolving market environments. Key points to remember about tactical passive allocation include that it is more active than pure strategic passive allocation, but less active than full active management. It focuses on adjusting asset class weights rather than selecting individual securities. The goal is to improve risk-adjusted returns by responding to short to medium-term market signals while maintaining a foundation of passive investments to keep costs lower. Overall, tactical passive allocation represents a practical option for financial institutions that seek to offer prudent and adaptable investment solutions.